Dear students, we are starting with the revisionary test paper of CA Intermediate Examination for November 2021, which has been extended to December 2021. So let us start with the financial management portion. My name is Dr. Chartered Accountant Kadikar Maulin. Starting with the question number 1, which is of the ratio analysis. Following information has been gathered from the books of CRAM Limited for the year ended 31st of March 2021. The equity shares of which is trading in the stock market at the rate of rupees 28. So market price of the equity share is given as 28 rupees. Equity share capital 20 lakhs, face value of equity share is 20. Preference share capital is 4 lakhs and the rate of preference dividend is 10%. Reserves and surplus is 16 lakhs. 12.5% debentures of 12 lakhs. Profit before interest and taxes, that is called operating income, EBIT, is an amount of 8 lakhs. Calculate the following when the company is falling in 25% tax bracket. The first question is ROCE, return on capital employed. Second question is EPS, earning per share. And the third question is price earning ratio. These are the three questions which we are required to answer. So let us have understanding that say how to make the calculation of return on capital employed. As far as the return on capital employed is concerned, in that we understand that the term capital employed stands for all long-term sources of finance taken together. It includes equity share capital, preference share capital, debentures, reserves and surplus, everything. So it is supposed to be calculated as operating income upon capital employed into 100. As far as the operating income is concerned, we can see the operating income is an amount of 8 lakhs. Divided by capital employed, that is say calculated as equity share capital plus reserves and surplus plus preference share capital plus debentures. So it is an amount of 8 lakhs divided by the capital employed is consisting of all long-term sources of finance, that is equity share capital 20, preference share capital 4, reserves and surplus 16 and debentures an amount of 12 lakhs. So it is 20 lakhs plus 4 lakhs plus 16 lakhs plus 12 lakhs into 100 for the purpose of getting answer in percentage term. So it is 8 lakhs upon 20 plus 4, 24, 24 plus 16, 40, 40 plus 12, that comes to 52 lakhs. Into 100 for the purpose of getting answer in percentage term. So 8 upon 52 on 200, 15.3846, so 15.38%. That is the way we can make the computation of the return on pre-tax basis. Now the same thing can be calculated on post-tax basis. Now the same can be calculated on post-tax basis. This is the pre-tax calculation. It is earning before interest and taxes into 1 minus T divided by capital employed. The amount of the operating income is 8 lakhs. Income tax rate is 25%. Divided by 52 lakhs into 100. This is the way we are required to make the computation of answer. So 8 into 0.75, that comes to 6 lakhs. Divided by 52 lakhs into 100. So 6 upon 52 into 100, it is 11.5384. So it is 11.54%. Whatever this answer that we already have computed, friends, directly it can be converted into post-tax term. So it is 15.38 into 1 minus 0.25. That comes to 11.535, that is 11.54%. The second question is calculation of the earning per share. So let us see how to make the calculation of answer. Earning per share. It will be calculated something like this. We start with the operating income, earning before interest and taxes, which is given to us in the question, an amount of 8 lakhs. From that we will subtract the interest amount. We can see that the company has issued the debentures of 12 lakhs and the rate of interest is 12.5%. $12 lakhs into 12.5%. That comes to 1,50,000. EBIT minus interest, that will give us earning before taxes. So 8 lakhs minus 1,50,000, that is 6,50,000. Income tax rate is 25%. So 8 lakh minus 1,50,000, 6,50,000 into 0.25. That comes to 1,62,500. Earning after taxes is 75%. So 650 minus 162.5. So 4,87,500. Less payment of preference dividend. As far as the preference share capital is concerned, it is 4 lakhs and the rate of dividend is 10%. So that comes to 40,000. Earning after taxes minus preference dividend, that will give us earning available to equity shareholders. So 4,87,500 minus 40,000, 4,47,500. The same will be divided with number of equity shares. We can see that the information is given that equity share capital is 20 lakhs and the face value of equity share is 20. This is 20 lakhs and face value of equity share is 20. Number of equity shares will be 1 lakh and that will give us earning per share. It is 4.475. That is the way the EPS can be found. Next is calculation of the PE ratio. PE ratio, price earning ratio, is very simple. It is market price of the share divided by earning per share. Market price of the equity share is given to us in the question, as rupees 28, and earning potential has been calculated by us in the earlier example, that is in earlier question 4.475. This will give us the price earning ratio 28 upon 4.475. That comes to 6.2569, or we can say 6.26. This is the way the price earning ratio can be found. So, small revision of the entire answer. The question says compute the return on capital employed, that is the operating income either on the pre-tax basis or post-tax basis upon capital employed, which is consisting of all long-term sources of finance taken together, that is equity, reserves, preference and debentures. Most importantly friends, over here one of the point for which students have number of times confusion is whether to find answer on pre-tax basis or post-tax basis. Looking to the suggested answer, institute has given both the answers, so that is what I would recommend you, that you should do in examination. Question number 2, it is based on the cost of capital concept. K Limited has an operating profit of an amount of 34,50,000 and has employed debt which gives the total interest charge of 7,50,000. It has cost of equity and cost of debt as 16% and 8% respectively. The firm has a new proposal before it, which requires the funds of 75 lakhs and is expected to bring an additional profit of an amount of 14,50,000, that is 25,000. To finance the proposal, the firm is expected to issue an additional debt at the rate of 8% and will not be issuing any new equity shares in the market. Assuming no tax, you are required to compute WACC, weighted average cost of capital of K Limited, before the new proposal and after the new proposal. So weighted average cost of capital is required to be calculated. So let us see before and after. We can start with the operating income. K Limited has an operating income of 34,50,000 and has capital employed which gives the total interest charge of 7,50,000. This is 34,50,000. Interest is 7,50,000. So difference of both of them is earning before taxes. So 34 minus 7, that comes to 27 lakhs. Earning after taxes is equal to earning before taxes. Why? Because we are required to ignore tax. Divided by cost of equity will give value of the equity. The question is providing us information that cost of equity is 16%. So as far as value of equity is concerned, it is 27 lakhs upon 16%. That is 1 crore 68 lakhs 75,000. Value of debt, we understand that the rate of interest is provided to us as 8% and amount of interest is provided to us as 7,50,000. So using this two information, we can compute the value of the debt. 7,50,000 divided by 0.08. That comes to 93,75,000. Value of equity plus value of debt. Total of both of them is value of firm. So value of the firm would be 1,68,75,000 plus 93,75,000. That comes to 2,62,50,000. This is the way the value of the firm can be calculated, say based on the existing information, which will be useful to us for the purpose of calculating weighted average cost of capital. It is found as earning before interest and taxes into 1 minus T divided by value of the firm. What is the amount of the EBIT? It is 34,50,000. Into 1 minus tax rate is 0 divided by value of the firm is 2,62,50,000. So 34.5 upon 262.5, that comes to 13.14%. This is the way weighted average cost of capital can be calculated. And cost of equity is already provided to us as 16%. Now once you accept the new project, then let us see that say what kind of information is given. It has been given that say the firm has a new proposal before it which requires an amount of rupees 75 lakhs and will bring an additional profit of 14,25,000. To finance the proposal, the firm is expected to issue additional debt financing at the rate of 8% and will not be issuing new equity shares in the market. So we understand something like this: the amount of the operating profit will increase, that is 34,50,000 plus an amount of 14,25,000. 34.5 plus 14.25, that comes to 48,75,000. Amount of interest, existing interest is going to remain same, 7,50,000. Again I am writing interest, in bracket I am writing new. It has been given that say 75 lakhs and the rate of interest is 8%. So an amount of 75 lakhs into rate of interest 8%, that comes to 6 lakhs. Okay. So 48,75,000 minus 7,50,000 minus an amount of 6 lakhs, that is 35,25,000. This is of course going to remain same. Why? Because there is no tax, there is no change in the equity, because the question is clearly providing that say we are going to raise the debt financing. So it is 1,68,75,000. So now what will happen? 35,25,000 divided by 1,68,75,000 into 100 for getting answer in percentage term, 20.88888. So it is 20.89%. Okay. As far as the value of the debt is concerned, it is 93,75,000 plus an amount of 75 lakhs. So 1,68,75,000 once again. Okay. Value of the firm would be 3,37,50,000. Okay. Next is the weighted average cost of capital. It is 48,75,000 into 1 minus tax rate is 0 divided by value of the firm 3 crore 37 lakh 50,000. Whatever the answer into 100. So 48.75 divided by 337.5, that comes to 14.44%. This is the way the weighted average or overall cost of capital can be calculated. Instead of finding the weighted average cost of capital like this, you may do the formula, and with that also you can make the computation of the answer. So if at all you go with the formula method, it will be like this. Calculation of WACC. In that, say equity and debt. I am writing over here before. Amount is 1 crore 68 lakh 75,000. So 168.75 lakhs. And as far as debt is concerned, 93.75 lakhs. Cost of capital 16% and cost of capital 0.08. So 168.75 lakhs into 0.16, that comes to 27 lakhs. 93.75 into 8%, that is 7,50,000. 7.5 is added to 27, that is 34,50,000. So weighted average cost of capital is cost divided by amount into 100. $34,50,000 divided by 168.75 plus 93.75, that comes to 262.5 lakhs. So 34.5 divided by 262.5 into 100 is 13.14%. This is the way we can compute the weighted average cost of capital if at all we work out in detail answer. Similarly, afterwards you are required to do answer like this: equity and debt. As far as equity is concerned, it is once again 168.75 lakhs. Debt will be 93.75 plus 75, so 168.75. Cost of capital is 20.89%, and over there it is say 8%. So 168.75 into 20.89%, that is 35.251875. One 68.75 into 8%, that is 13.5. That is 48.751875 lakhs. Based on that weighted average cost of capital, 48.751875 lakhs divided by total is 337.5 lakhs. Final answer is 48.751875 lakhs divided by 337.5 lakhs. That is 14.445. That is 14.45%. This is the way weighted average cost of capital can be calculated. So friends, concluding the point, before we accept the new project, we have made the computation of the value of the firm and based on that weighted average cost of capital, or otherwise say we can have a small table to make the computation of the weighted average cost of capital for before and after say accepting the new project. This is the way we are required to do answer. Question number 3. Third question is, Blue Limited, an all equity finance company, is considering the repurchase of rupees 275 lakhs equity shares and to replace with 15% debentures of the same amount. The current market value of the company is rupees 1750 lakhs with its cost of capital of 20%. The company's operating income are expected to remain constant in future. The company also has a policy of distributing its entire earning in form of dividend. Income tax rate is only 30%. Calculate the impact on the following on account of the change in the capital structure as per Modi, Gilani and Miller approach, that is called approach. Market value of the firm, weighted average or overall cost of capital and cost of equity. These three things are required to be calculated. So friends, over here information is given that say it is an all equity finance company, so weight of equity is 1, is considering repurchasing of 275 lakhs of the equity shares and to replace with the 15% debentures of the same amount. So debt financing for redemption of the equity share capital. Market value is provided to us as 1750 lakhs and cost of capital is given to us as 20%. So cost of equity itself is the weighted average cost of capital 20%. Operating income is going to remain same. Dear students, this information is not required to be given. It is assumed even otherwise. The company's policy is having said the 100% dividend payout ratio, not required to be given. It is assumed otherwise. Income tax rate, that is important. And we are required to apply the approach. I am ignoring the questions which have been provided to us and I am doing answer. Then we'll read the questions and with that say definitely able to understand all answers. So calculation of value of firm and weighted average cost of capital before and after capital restructuring. So let us see how to calculate the answer. It is before and after. Before means say before buyback and after means after buyback. In that say we can start with the operating income, earning before interest and taxes. Dear students, it has been provided to us that say right now the operating income of the company is an amount of, okay, we are required to do backward working. So EBIT minus interest is earning before taxes minus income tax liability 30%. Earning after taxes is 70%. Divided by cost of equity will give value of equity, will add value of debt, and total of both of them is value of the firm. And lastly, we will have weighted average cost of capital. We can see that over here information is provided to us that current value of the firm is an amount of rupees 1750 lakhs. That is what's provided to us. Value of the debt is 0. Value of the equity is 1750 lakhs. We have been provided with the information that the cost of capital is 20%. So what happens at over here, as far as earning after taxes is concerned, it must be 350 lakhs. How this 350 lakhs is calculated, dear students? It is 1750 lakhs into 0.20. So we understand something like this. Value of equity is equal to earning after taxes divided by cost of equity. So earning after taxes is value of equity into cost of equity. What is value of equity? 1750 lakhs. What is cost of equity? 20%. That is the way we make the computation of answer 350 lakhs. On a safer side, I was cross verifying. Income tax rate is given to us as 30%. So we can compute the earning before taxes like this. It is earning after taxes 350 lakhs divided by 0.70, because income tax rate is 30%. So 350 divided by 0.7, that comes to 500 lakhs. Tax rate is 30%, that comes to 150 lakhs. This is the way we are required to compute the answer. Okay. So we understand that the next working is just in detail working. Calculation of EBT. Earning after taxes is earning before taxes minus income tax payment. This is 350 lakhs. This is 5, that is, so this is earning before taxes into 1 minus tax rate, because EBT is supposed to be found. So it is 350 lakhs divided by 1 minus income tax rate is 30%. So 350 divided by 0.7, that comes to 500 lakhs. That is the way, so the EBT is calculated an amount of 500 lakhs. Amount of interest is right now 0, and operating income will be an amount of 500 lakhs. Later on, operating income is 500 lakhs. Again, question is providing, even otherwise we will make that assumption. 275 lakh rupees is the amount of the debt financing that we are going to issue to repurchase the equity shares, and the rate of interest is 15%. So 275 lakhs into 15%. That is 41,25,000. That is deducted from 500, 458.75 lakhs into 0.30, so 137.625 lakhs. So the remaining amount is 458.75 minus 30%. That comes to 321.125 lakhs. Now importantly, cost of equity is going to increase. Why? Because risk for equity shareholders will increase. So what is value of equity? We do not know. For value of the debt, dear students, at our intermediate level, usually we have the book value itself as the market value, because as such no valuation principle is provided to us over here at our intermediate level. Value of the firm that is required to be computed, say once we go for the buyback, value of firm post capital restructuring. In that case, it is required to be found like this. Value of the levered firm is equal to value of unlevered firm plus present value of interest tax saving. What is value of unlevered firm? It is an amount of rupees 1750 lakhs. That is this. Plus present value of the interest tax saving can be calculated by using a very simple formula. It is value of debt into income tax rate. 1750 lakhs plus 275 lakhs into 0.30. 1750 lakhs plus 275 into 0.3. That comes to 82,50,000. So the total answer comes to 1832.5 lakhs. This is the way value of the levered firm can be calculated. So it is 1832.50 lakhs. Before capital restructuring, the weighted average cost of capital is of course 20%. That is equal to the cost of equity. Why? Because there is no debt financing. Now friends, as far as this component is concerned, that is the present value of the interest tax saving is concerned, it can be calculated using an alternative formula. It is like this. Just for understanding purpose, I am telling you. Present value of interest tax saving can be calculated as interest tax saving divided by rate of interest. So interest tax saving is found as interest into tax rate divided by rate of interest. The amount of interest has already been calculated by us over here. It is 41.25 lakhs. So it is 41,25,000 into income tax rate 30% divided by rate of interest, and the rate of interest is provided to us in the example as 15%. 4125,000 into 0.30. This is the tax saving divided by 0.15. That comes to 82,50,000. Since we are going to get the advantage of the tax saving for the perpetuity, so we apply the formula A1 divided by I. Now this present value of the interest tax saving is added to the value of unlevered firm to compute the value of the levered firm. Now it's very simple, all of you can understand. 1832.5 minus 275, that gives us the value of the equity 1557.5, and cost of equity will be found as balancing figure 321.125 divided by 1557.50 into 100 for getting answer in percentage term. So that comes to 20.62%. That is 321.125 divided by 1557.50. This is the way cost of equity can be calculated as balancing figure. So this is the way we are required to make the computation of answer. And the last one more thing is the weighted average cost of capital. For that, it is operating income 500 lakhs, that is converted to post tax 0.70 is 350 divided by 1832.50, that comes to 19.099. So it is 19.10%, and definitely it was supposed to be lower than what it was earlier because of the interest tax saving advantage that you get. So calculation of weighted average cost of capital after buyback, very simple formula: net operating profit after taxes upon capital employed into 100. Net operating profit after taxes is EBIT into 1 minus T divided by capital employed, that is over here value of the firm rather. So value of the firm is 1832.50 into 100 for getting answer in percentage term. 500 lakhs into 1 minus 0.30 divided by 1832.50 lakhs into 100 for getting answer in percentage term. So 350 upon 1832.5, that is 19.099. So I take it 19.10. This is the way we are required to write the answer. Let me revise you the entire answer before we read the questions which they have provided to us. Dear students, in this kind of question, my first suggestion to all students is to write this format. Operating income minus interest is EBT, minus tax is EAT, divided by K is value of equity, plus value of the debt is value of the firm, and lastly weighted average cost of capital. Basically we start over here, so with the value of the equity which is given to us in the question, and that itself is the value of the firm. Why? Because there is no value of the debt. The question is providing the information about the cost of equity, that's it. Then you are required to follow the backward working over here. You compute EAT, then EBT and EBIT, so on. You make the entire working, and this is the way the column number 1, that is in terms of the values, is completed. The amount of the operating income is going to remain same, is specified, even otherwise we make that assumption, minus the interest amount, that will give us EBT, minus tax amount will give EAT. So we have to stop at this point of time. We cannot proceed further. Why? Because say for making further calculation we do not have the sufficient information. Basically we understand that, say, depending upon the capital structure theory information given to us, we are required to fill up the values. In case of the net operating income approach, Modi-Gilani-Miller approach, the contention is that, say, when there is an increase in the debt financing, then in that case expectation of the equity shareholder is going to increase. So now importantly we make the computation of the value of the firm, and for that say you need to apply the formula value of the equity plus present value of the interest tax shelter. Then value of the debt is deemed to be included in the value of the firm, so we compute the value of the equity as balancing figure. You have two things, earning after taxes, yes, value of the equity, again yes. Now based on that say we make the computation of the cost of equity. That is the way, so the cost of equity is calculated over here. This is what say we understand is the way we make the computation of the answer. Let us read the questions that say they have provided. Definitely we will be able to answer all of them easily. The question says that say calculate the impact on the following on account of the change in the capital structure. So market value of the firm which is required to be found is, it is 1832.50. Weighted average or overall cost of capital is 19.10%, and cost of equity is 20.62%. Yes, that is the way we are required to make the calculation of the answer. Question number 4. The following particulars relating to Navia Limited for the year ended 31st of March 2021 is given. Output is given 1 lakh number of units, that is the normal capacity. Per unit selling price is 40, per unit variable cost is 20. The amount of the fixed cost is 10 lakhs. Capital structure of the company as on March 31st, 2021 is as follows. Equity share capital, reserves and surplus, 7% debentures and current liabilities. So the total is 30 lakhs. Navia Limited has decided to undertake, highlight the portion, an expansion project to make the market potential, to use the market potential that will involve an amount of 10 lakhs. The company expects increase in the output by 50%. Fixed cost will be increased by 5 lakhs. Per unit variable cost will decrease by 10%. Additional output can be sold at the existing selling price without any adverse impact on the market. It means that you will be able to sell the additional product, that is additional output, at the same price. The following alternative schemes for the financing the proposed expansion are available. Entirely by equity shares of rupees 10 at par, that is at face value. Rupees 5 lakhs by issue of the equity shares of 10 and balance by issue of the 6% debentures of 100 rupees again at face value. Entirely by 6% equity, that is the debentures of 100 rupees. Means 3 options: equity, debt. Find out which of the above mentioned alternative would you recommend for the company with reference to the risks and return that is involved, assuming income tax rate is 40% . So over here we are required to make the computation of say the which alternative is best for the company. Let us say make the calculation of the earning per share say for each of the financial plan. The first one is 100% equity. The question is providing the information that we require an amount of rupees 10 lakhs. Issue price is 10. So in this situation, we will issue additional 1 lakh number of shares. In the second case, rupees 5 lakhs by issue of the equity shares of 10 and the remaining is by way of debentures. So I am preparing working note number 1 over here. Calculation of number of equity shares to be issued for each plan. First plan, second plan and third plan. As far as equity financing is concerned, in the first case it is entirely an amount of 10 lakhs, 5 lakhs and 0. 10 lakhs, 5 lakhs and 0. So number of equity shares, in the first case it will be 1 lakh. That is 10 lakhs upon 10. In the second case it is 50,000. It is 5 lakhs upon 10. And in the last case, say the number of equity shares will be 0. That is additional number of equity shares, because that is entirely the debt plan. Next, calculation of EPS, earning per share, for each plan and leverage. Because dear students, you can see that over here the question is providing the information that say you are required to make the computation of the earning per share, and at the same time say you are required to say recommend that say with reference to the risk involved. So we are required to compute the risk that is in form of leverage for decision making. So let us see how to calculate the answer. So the plan 1, that is entire equity, plan 2 debt and equity, plan 3 it is entirely debt, and for that say we are required to compute the answer. We start with the sales and will go up to the earning per share and the leverage calculation. As far as sales is concerned, as per the given information, there is increase in the output by 50%. So this 1 lakh number of units plus 50%, 1,50,000, and the selling price is 40. So we understand that it is 1,50,000 into 40. Next is a variable cost. Presently the variable cost is 20 rupees. However, it has been given that say the variable cost will decline by 10%. So it will decrease to 18 rupees. 1,50,000 number of units into 18, that is 20 rupees minus 10%. Difference of both of them is contribution. Basically we are making the computation of the contribution because later on for calculation of the degree of operating leverage it would be required. Less fixed cost. The amount of the fixed cost is provided to us in the example as 10 lakhs. The question is providing the information that it will increase by 5 lakhs. So from 10 lakhs it will increase to 15 lakhs. Contribution minus fixed cost will give the EBIT, operating income, that is earning before interest and taxes, minus interest. Now the calculation of the interest is going to be interesting, that is important. First of all, I am writing the existing interest. The question is providing the information that say you already have raised the debt financing 10 lakhs and the rate of interest is 7%. That comes to an amount of 70,000. Interest in bracket I am writing new. In the first case it is 0. Why? Because 100% that is equity financing. EBIT minus interest will give EBT. From that, so the tax will be deducted to compute the earning after taxes. There is no preference evident. So earning after taxes itself is the earning available to equity shareholders divided by number of equity shares. You can see that say existing number of equity shares are 1 lakh and there will be an additional issue of equity shares of 1 lakh. So 1 plus 1, that comes to 2 lakh number of shares. 1 lakh plus 1 lakh. Earning after taxes divided by number of shares will give the earning per share. This is the way the EPS can be calculated for the first plant. So let us start with the working. 1 lakh plus 50,000, 1 lakh 50,000 into 40 selling price. So that will give us the sales value, that is an amount of rupees 60 lakhs. Now again 1 lakh 50,000 into 18, that is variable cost. So that will give us 27 lakhs. 60 lakhs minus 27 lakhs is 33 lakhs. That is the contribution. Minus fixed cost 15 lakhs. That will give us operating income of 18 lakhs. Minus 70,000. That comes to 17 lakh 30,000. Income tax rate is given to us. Income tax rate is given to us as 40%. So 17 lakh 30,000 into 40%, 6 lakhs 92,000. So 17 lakh 30,000 minus 6 lakhs 92,000, that comes to 10 lakh 38,000, that is earning after taxes. Divided by number of equity shares 2 lakhs and the EPS is 5 rupee 19 paise. That is the way the EPS can be calculated for the first one. Then we can compute DOL, degree of operating leverage, DFL, degree of financial leverage, and DCL, degree of combined leverage. That is the way the leverage can be calculated. Now we will make the calculation of the degree of operating leverage. Degree of operating leverage is calculated because the question is providing with the information that we are required to measure even the risk. So the question says that say find out from the above mentioned alternative, which alternative would you recommend for Navia Limited with reference to the risk. So we'll measure the risk in form of leverage. So as far as the degree of operating leverage is concerned, it is contribution upon EBIT, that is 33 lakhs upon 18 lakhs. That is the way we'll make the calculation of answer. So over here it is a contribution upon operating income. Contribution is 33 lakhs and operating income is 18 lakhs. That is the way we can make the calculation of answer. So 33 upon 18, that comes to 1.833333. Degree of financial leverage is operating income, EBIT, upon earning before taxes, that is 17 lakh 30,000. So 18 lakhs divided by 17 lakh 30,000. So 18 upon 17.30. So 1.0404, or we can take 0.5 also. That is the way the DFL is calculated. Degree of combined leverage is product of these two, that is DOL and DFL. So in that case it is 1.8333 into 1.0405. That is 1.9075. That is the way the degree of combined leverage can be calculated. Now let us make the required calculation for the second alternative. The second alternative is the alternative in which we are going to have the equity financing of rupees 5 lakhs, and at the same time say we will be having the debt financing of the balancing amount, that is again 5 lakhs. That is the way we will have the financing pattern. As far as sales is concerned, it is going to remain same, an amount of 60 lakhs. Variable cost is 27 lakhs. Contribution is 33 lakhs. Fixed cost is 15 lakhs. Operating income is 18 lakhs. As far as existing interest is concerned, that is not going to change. It will be 70,000 rupees itself. And as far as the new interest is concerned, in that we are going to have the debt financing of an amount of rupees 5 lakhs, because 5 lakhs is going to be the equity financing. So the remaining 5 lakhs will be the debt financing. For that, the rate of interest is given to us as 6%. So what will happen? It is 5 lakhs into 6%. That comes to an amount of 30,000. EBIT is 18 lakhs minus amount of existing interest is 70,000. Amount of the new interest is 30,000. So the earning before taxes is 17 lakhs. Income tax rate is provided to us as 40%. So earning before taxes into 0.40, that is tax amount is 6,80,000. So the remaining is earning after taxes. So the amount of earning after taxes is 10,20,000. Number of equity shares are existing 1 lakh, plus in the second option we will be having additional issue of the equity shares 50,000. So the total number of shares will be 1,50,000. 1020 divided by 1,50,000. So the earning per share is 6 rupees 80 paise. As far as the degree of operating leverage is concerned, it is again contribution 33 lakhs divided by EBIT 18 lakhs. So the answer is going to remain same, 1.8333. That is the way the DOL can be calculated. Next, let us see. The third alternative is we are going to have only the debt financing and there is no equity financing. In that case, let us see that say how to make the calculation of answer, and before that say just let us compute the DFN. It is EBIT, that is 18 lakhs, and EBT is 17 lakhs. So this is 18 lakhs divided by 17 lakhs. (18 upon 17). 1.0588. Okay. Now DCL is 1.8333 into 1.0588. So 1.0588 into 1.83333. So 1.9411. That is the way the DCL, degree of combined leverage, can be calculated. Next, where there is entire debt financing, even in that case, as far as the sales is concerned, it is going to remain same, 60 lakhs. Variable cost no change, 27 lakhs. Contribution no change, 33 lakhs. Fixed cost same, 15 lakhs. EBIT same, 18 lakhs. Existing interest same, 70,000. New interest will be 10 lakhs into 60%. That comes to an amount of 60,000. Sorry, 6%. So what will happen? It is EBIT 18 lakhs minus amount of existing interest is 70,000 minus new interest is 60,000. So it comes to 1670. Into 0.40. Income tax is 6,68,000. It is deducted from 1670. So it is 10,02,000. Number of equity shares will remain 1 lakh itself, because it is entirely the debt financing. There is no equity financing. So earning per share calculation is very simple. It is 10.02. DOL will remain same. As far as the DFL is concerned, it is again EBIT 18 lakhs upon 1670. 16.70 lakhs. So 18 upon 16.7, that comes to 1.0778. So as far as the DCL is concerned, it is 1.833 into 1.0778. So 1.8333 into 1.0778. That comes to 1.9759. This is a way DCL, degree of combined leverage, can be calculated. Now, whatever the working that we have done, friends, based on that, say we can say something like this. There are three financial plans that we have. The 1, 2, 3, wherein we can say that, say, it is only equity plus debt, and only debt. If at all we make a comparison of earning per share, then in that case the first rank is going to this, that is the only debt financing. Why? Because it is having the highest earning per share. So it is 5 rupee 19 paise. Next it is 6 rupee 80 paise. Then it is 10 rupee 2 paise. That is the way the earning per share can be calculated, so for each of the plan. DOL, degree of operating leverage, is same for all of them, 1.8333. Next is degree of financial leverage. As far as the degree of financial leverage is concerned, of course it is going to be the lowest in case of the only equity financing and highest in case of only debt financing. So 1.0405, then 1.0588, 1.0788. As far as DCL is concerned, it is in the first case 1.9075. Of course, it is going to be the lowest once again. 1.9411. It is comparatively more. And lastly, it is 1.9759. This is the way we can make the computation of the all working. So now based on this working, we can say that there is the highest earning per share in case of the plan 3, but it has the highest risk also. And as far as the equity is concerned, it has the lowest earning per share and it has lowest the leverage also. So as far as the only equity financing is concerned, it has less risk and the low return. As far as the only debt financing is concerned, it has highest risk and highest return. As far as the equity plus debt combination is concerned, you can see that all the values are falling in between both of them. So if at all the company is having the more risk bearing capacity, it should be going for that is only debt. Less risk bearing capacity, it should go for only equity. If it is having moderate risk bearing capacity, it should be going for the combination of the equity and debt. Should I done answer the question? The company is advised to select financial plan of only equity, comma, if it has high risk bearing capacity. Full stop. The company should select only equity if it has low risk bearing capacity. Full stop. With paragraph write down, only equity will have less risk and less return. Only debt will have more risk and more return. Full stop. Combination of debt and equity has moderate risk and moderate return. Full stop. This is the way we can draw the conclusion. Let us see the next question. This question is from the chapter of capital budgeting, investment decision. HMR Limited is considering replacing. So the question is providing the information about the replacement. Manually operated old machinery with fully automatic new machinery. old machinery had been fully depreciated for income tax purpose but has a book value of 2,40,000. So as far as the income tax book value is concerned, it is 0. Fully depreciated means it has income tax WDV 0 and it has a book value, that is the accounting book value, of 2,40,000. The machine has begun causing problems with the breakdown and it cannot fetch more than 30,000 if sold in the market at present. So the current sale value is 30,000. It will have no realizable value after 10 years. The company has been offered an amount of rupees 1 lakh for the old machinery as a trade-in for the new machinery. Trade-in means a kind of like the exchange value of 1 lakh rupee, which has a price before allowance of the trade-in is 4,50,000. So the company is selling the new machinery to us is ready to take the existing machinery from us for an amount of rupees 1 lakh, even though it has the market value of only 30,000. Life of the new machinery is 10 years with the salvage value of 35,000. So existing machinery can be used for another 10 years, or otherwise it can be replaced with the new machinery which has a life of again 10 years. Straight line method of depreciation for tax purpose. Written down value at the rate of 7.5% is allowed for taking this as oldie machinery in the block of asset. So it has been given that the company itself is following SLM, but for income tax purpose, say it is 7.5% is allowed, and this is the oldie machinery in the block. Given below are the expected sales and the cost from both old machinery and new machinery. Sales is given, material cost is given, labor, variable overhead, fixed overhead, depreciation, profit, tax and profit after taxes is given. This 2,40,000 is of course calculated as 24,000 is calculated as 2,40,000 divided by 10 years. From the above information, analyze whether the old machinery should be replaced or not. Cost of capital is given as 10% and highlight the portion ignore income tax, that is capital gain tax. Present value factors have been provided to us from end of year 1 to end of year 10. So now over here we are required to decide whether to replace this machinery or not. Now let us have understanding that say how to make the calculation of the answer. Dear students, over here we can adopt incremental approach for the decision making. The reason for that is very simple. We can see that the balance life of existing machinery and the life of the new machinery are same. That is the reason we can adopt the incremental approach for decision making. Usually we will follow the NPV criteria for decision making. So we will make the calculation of the NPV for replacement of the machinery. So let us work out the answer with one by working notes. So answer for question number 5. In that, replacement of machinery. So let us see that in that case, say how to take the decision. So now in the replacement of the machinery, let us start with the step number 1. In that, investment. Existing machinery and new machinery. If at all we continue with existing machinery, then of course, so there is no investment which is required to be made. So the amount of the investment is 0. If at all you replace the existing machinery with the new machinery, then in that case you have to make investment. So it is buy new machinery for an amount of 4,50,000 less sale existing machinery for an amount of rupees 1 lakh. The question is specifically providing that you have to ignore the capital gain tax calculation. Further friends, over here with respect to the existing machinery, we have been provided with the two values. If at all we make an effort to sell the machinery in the market, we can get hardly 30,000. While over here the supplier is ready to buy our machinery for an amount of 1 lakh. So really we are fortunate that say we will be able to get 1 lakh rupee. So the amount of the investment that you have to make is 3,50,000 if at all we replace. So the amount of the incremental investment is 3,50,000 minus 0, that is 3,50,000. Step number 2 is depreciation. In my opinion, so this is an important working note that we have from examination point of view. The question is providing with the information that an amount of 2,40,000 is the book value. Always remember that say the book value of the asset is never relevant say for the purpose of calculation of the cash flow. Only and only income tax WDV is relevant, which is 0. So if at all you continue with the existing machinery, then in that case the amount of the depreciation that you can claim is 0. If at all you buy the new machinery, then in that case what is the amount of the depreciation that you can claim is what we are going to calculate. Straight line method of the depreciation information which has been given to us in the question is again of no use to us, because this 24,000 is irrelevant. This 41,500 we can understand it like this: 4,50,000 purchase price minus 35,000 divided by the number of years is 10. So 4,50,000 minus 35,000, so 4,15,000 divided by 10. That is the way this 41,500 is given. However, again it is of no use to us. Why? Because from tax point of view, which method is allowable? WDV. So we have to follow the WDV method. And the question is providing with the information that say you have to follow the block of asset method of depreciation. So dear students, first of all we are required to prepare working note. That is working note number 1. Calculation of WDV on which depreciation can be charged. So it will be calculated as opening WDV plus purchase price of new machinery minus sale value of existing machinery. This is the WDV on which you can claim depreciation. So what is opening WDV? 0, because we have to take it from tax point of view. Purchase price of the new machinery is 4,50,000 minus sale value of existing machinery is 1 lakh. So 3,50,000 is the amount on which you can claim depreciation. So over here, first of all we understand that say we have computed that say what is the amount on which you can claim depreciation if at all you replace existing machinery is 3,50,000 and the amount on which you could have claimed depreciation is 0. Why? Because as far as the existing machinery is concerned, its WDV 0. So what is the incremental WDV? Incremental WDV is 3,50,000 minus 0, 3,50,000. Now on this you will claim the depreciation for 10 years. Yes. So over here it is column number 1 is year, column number 2 is opening WDV and column number 3 is depreciation. First year, second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year and ninth year, and lastly 10th year. Incremental WDV is 3,50,000. Rate of depreciation is 7.5%. That comes to 26250. Then 3,23,750 into 7.5%. That is 24,281. Then 299,469 into 7.5% once again 22,460. So 2,77,000 rupees 9. $20,776. 2,56,233. 19,217. 237,016. 17,776. 2,19,240. 16,443. 2,02,797. 15,210. 1,87,587. 14,069. 173,518. 13,014. This is the way the depreciation can be claimed from end of year 1 to end of year 10. So we have made calculation of first of all the incremental WDV on which you can claim depreciation, and we have found the incremental depreciation from end of year 1 to end of year 10. Then step number 3, calculation of terminal cash flow. For existing machinery and for new machinery. As far as existing machinery is concerned, it is 0, because right now you can fetch an amount of 30,000, but if it is sold after 10 years, it will have no realizable value. And for the new machinery, it is provided an amount of rupees, say 35,000. We do not have to make the calculation of the capital gain tax. So it is 35,000 rupees. It is year 10 end. Now step number 4. Calculation of recurring cash flow. Dear students, in case of the recurring cash flow, we can make simple working like this. As far as the existing machinery is concerned and new machinery is concerned, we have been provided with the information about the sales, material, labor, variable overhead, fixed overhead. Depreciation is not something that we are going to consider. So the profit before taxes, in that the depreciation will be added to compute the profit before depreciation and taxation. So what we can do over here, we can make the calculation of profit before depreciation and taxation. as far as the existing machinery is concerned, in that 324,750 plus 24,000, so 348,750, 3,48,750. It is 324,750 plus an amount of 24,000. For the new machinery, it is 387,250 plus 41,500. 387,250 plus 41,500. That comes to 428,750. So with the new machinery, of course, the profit is more. So what is the incremental value? As far as the incremental profit before depreciation and taxation is concerned, it is 428,750 minus 348,750. That comes to an amount of rupees 80,000. So this is the way we can make the computation of the incremental profit before depreciation and taxation with the replacement of the machinery. Now step number 5. In this only further calculation of the cash flow. Dear students, over here we can see that the incremental depreciation for year 1 is 26,250. So I am giving you some detailed working for year 1. As far as year 1 is concerned, we can have a detailed working like this. Profit before depreciation and taxation is an amount of 80,000. What is the amount of depreciation? Amount of the depreciation is 26,250. So 80,000 minus 26,250. So that comes to profit before profit before taxation 53,750. Income tax rate is 40%. So the tax is 21,500. So profit after taxes is 60%. Oh, tax rate is 30%. So 53,750 into 30%. So the tax amount is 16,125. Profit after taxes is 37,625. We add back depreciation in order to compute the cash flow after taxes. So 37,625 plus 26,250. It comes to 63,875. Okay. Now this can be calculated by using a shortcut method. Why I am recommending, or why do I suggest at this point of time a shortcut method? The reason for that is that the amount of the depreciation is every year different, and the amount of the profit before depreciation and taxation is same on the annual basis. So in this question I suggest you to do something like this. Profit before depreciation and taxation is 80,000. At this point of time the tax is calculated at the rate of 30%. Of course the amount of the tax liability that we are going to calculate will be wrong. That is an amount of 24,000. So we will be having profit before depreciation after taxation. That comes to an amount of 56,000. Now we know that depreciation is a non-cash item, so we have only depreciation tax saving, DTS, depreciation tax saving. What is the depreciation amount? 26250. What is tax rate? 30%. So 26250 into 0.3, that comes to 7875. So dear students, what happens that actual income tax liability is 16,125. Instead of that, say we have computed over here wrong, 24,000 minus 7875. So you can see that say you will be able to find the correct tax liability. So you get the CF18. So it is 56,000 plus 7875. That comes to 63,875. So over here, in order to compute the cash flow, we can have a working like this, in which the depreciation tax saving will be the depreciation into tax rate. Okay. Now listen carefully. Step number 5. In that calculation of NPV, in that I am preparing the working notes like this. Listen me carefully. Working note number 1, calculation of present value of depreciation tax savings. Yes, whatever the tax saving that we have on the yearly basis, its present value will be calculated. So over here it is year, column number 1. Depreciation tax saving is column number 2. That is depreciation into tax rate every time, multiplying with the present value factor which is given to us in the question. And based on that, so the present value of depreciation tax saving. This is what say we are going to have end of year 1 to end of year 10 its present value. Then we'll make the calculation of the NPV by using a simple formula. I just tell you what is the formula. NPV is equal to present value of the cash inflow minus investment. Now present value of the cash inflow will be consisting of the two components. Present value of profit before depreciation after taxation plus present value of depreciation tax saving minus investment. So what will happen? It is 80,000 into 1 minus 0.30, so it is converted into post-tax into PVIFA at the rate the cost of capital whatever provided to us in the example. It is 10% for 10 years. 10% for 10 years, that summation that will keep over here, plus present value of the depreciation tax saving based on this working note whatever we compute, minus the amount of the investment 3,50,000. This is the way we'll make the calculation of the NPV. So like I hope you understand, profit before depreciation and taxation minus depreciation, profit after, that is before tax, post tax you add back depreciation and you compute the cash flow. Doing like this for 10 years and then discounting. Instead of that, say for present value of the depreciation tax saving, I prepare a separate working note, and so the profit before depreciation and taxation is converted into post-tax term for the purpose of making NPV calculation. So let us start with the working. As far as year 1 is concerned, amount of depreciation tax saving, it is 26250 into tax rate. That comes to 7875. In the second year, again we are required to make the computation of the depreciation tax saving, and based on that, say we can compute the answer. So now again the depreciation into tax rate, So 24281 into 0.3. So 7284.30. Subtracted 7284. Then 22460 into 0.3, 6738. 20776 into 0.3, 6233. 19217 into 0.3, 5765. 17776 into 0.3, 5333. 16443 into 0.3, 4933. 15210 into 0.3, 4563. 14069 into 0.3, 4221. 13014 into 0.3, 3904. This is the way we get the tax saving and then present value of the tax saving. 7875 into 0.909, so 7158. 7284 into 0.826, 6017. 6738 into 0.751, 5060. 6233 into 0.683, 4257. 5765 into 0.621, 3580. 5333 into 0.564, 3008. 4933 into 0.513, 2531. 4563 into 0.467, 2145. 4221 into 0.424, 1790. 3904 into 0.386, 1507. 'So the total of all of them is equal to 37,053. Okay. Now let us do further working. Total of this 10 years annuity factor is 0.909 plus 0.826, 751, 683, 621, 564, 513, 467, 424, 386, 6.144. So over here we will be having a working like this: present value of the cash inflow minus investment. In that's a present value of the profit before depreciation after taxation plus present value of the depreciation tax saving plus present value of terminal cash flow minus investment. So what will happen? It is 80,000 into PVIFA at the rate of 10% for 10 years plus in the last, that is present value of the depreciation tax saving is 37053 plus present value of the terminal cash flow. We know that the amount of the terminal cash flow is rupees 35,000. That is 35,000 minus 0, 35,000 into 0.386. Minus the amount of investment 3,50,000. This is the way we are required to do answer. $80,000 into 1 minus tax rate. So 80,000 into 0.7, that comes to 56,000. 10 years annuity factor is 6.144 plus 37053 plus 35,000 into 0.683, sorry, 386, 13510 minus 3,50,000. So 56,000 into 6.144 plus 37053 plus 13510 minus 3,50,000. So the NPV is 44,627. That is the way the NPV can be found. So we can write the conclusion like this. As NPV is positive, comma, machinery should be replaced. This is the way we can draw the conclusion. Just a final conclusion, that you can also make the computation of the cash flow as routine that we do. Profit before depreciation and taxation minus depreciation, PBT minus tax, PAT, add back depreciation, cash flow. I am dictating a few points over here for your understanding. Of course, it is not forming part of the answer, but that is only for understanding purpose. The first thing is, information about accounting book value is irrelevant. Full stop. Second, information about method of depreciation SLM, straight line method, for accounts is irrelevant. Full stop. Third, we can adopt incremental approach because balance life of existing machine and life of new machine are same. Full stop. Question number 6. It is from the chapter of risk analysis and capital budgeting. TIP Limited is considering two mutually exclusive projects, M-N. You have been given the below net cash flows and the probability distribution for each of the project. Cash flows are 62,500, 75,000, 87,500. Similarly, over here the cash flows have been given along with the probability distribution. The first question is calculation of the expected net cash flows for the each project. So it is probability into cash flow. With that, so the mean value can be found. Variance. Variance will be found as x minus x bar square into probability. Summation of that is the variance. Standard deviation. Root of variance is standard deviation. CV, that is coefficient of variation, that is risk upon return, that is standard deviation divided by x bar will give the CV. And the final question is identify which project would you recommend with the reasons. So let us first of all complete the working for, so the initial questions wherein more computations are required. So first of all I am doing it for M project. So I am writing answer for the first question. Calculation of expected cash flow and variance. Since we can do both of them in one table only, so I am doing both of them together. We'll do it first of all project M. In that, say we will be having the working like this: probability, cash flow. I am assigning x variable to it. Probability into x. Summation of that will give x bar, x minus x bar. Then x minus x bar whole square into probability. Summation of that is variance. This is the way we are required to do answer. So 3, 3 and 4. So in the probability column 3, 3 and 4. In the cash flow column 62,500, 75,000 and 87,500. This is 62,500. This is 75,000. And for the last it is like 75,000. Sorry, 87,500. Probability into x. Then mean value will be x bar, x minus x bar, square of the same into probability, and summation of that is variance. So now it is the probability 0.3 into 62,500, that is 18,750. Then 0.3 into 75,000. $22,500. 0.4 into 87,500. 35,000. X bar, that is the mean value, it is 76250. That is the way mean value can be found: 18750 plus 22,500 plus 35,000. Okay. Then x minus x bar, x is 62,500, x bar is 76250. That is 13750 negative. 75,000 minus 76250. So it is 1250 negative. $87,500 minus 76250 once again. So 11250 positive. Next is x minus x bar whole square into probability. So what will happen, it is 13750 negative raised to 2 into 0.30. Next is 1250 negative raised to 0.3, that is into 0.30. Then 11,250 raised to 2 into 0.40. This is the way we can make the computation of answer. So 13750 square into 0.3. So it comes to 5 crore 67 lakhs 18,750. Square of 1250 into 0.3, 4,68,750. 11250 square into 0.4, that comes to 5 crore 6 lakhs 25,000. Now we'll make the total. 5 crore 67 lakh 18,750 plus 4 lakh 68,750 plus 5 crore 6 lakhs 25,000, that comes to 10 crore 78 lakhs 12,500. This is the way the mean value and variance is calculated for project M. We'll do the similar working for N. So after M it will be N, for which we will be doing answer. Same columns. Column number 1 is probability. Column number 2 is cash flow. We assign Y variable to it. Probability into Y. We'll get the Y bar. Y minus Y bar. Then it is Y minus Y bar whole square into probability, and summation of that will be variance. This is the way we are required to make the computation of the variance, and then under root of the same later on that we will be doing for calculation of the standard deviation. Probability column is 2, 3, 5. So it is 2, it is 3, and it is 5. Accordingly, we are required to calculate the answer. The cash flows are 160 to 500, 137 500, and 112 500. This is the way we are required to calculate the answer. So there are 20% chances cash flow will be 160 to 500. So it is 30 to 500. There are 30% chances it will be 137 500. So it is 41250. There are 50% chances 1,12,500. So 56250. So it is Y bar, that is the mean value. So it is 1,30,000. $32,500 plus 41250 plus 56250. Okay. Now Y minus Y bar. So 160 to 500 minus 1,30,000. That is 32,500. 137,500 minus 1,30,000. 7,500 positive. Then 1,12,500 minus 1,30,000. So it is 18,500 negative. So 162,500 minus 130. So 32,500. 137,500 minus 130. 7,500 positive. 112,500 minus 130 is 17,500. So now y minus y bar whole square into probability. So it is square of 32,500 into 0.20. So the answer is 21 crore 12 lakh 50,000. Square of 7,500 into 0.30. 1 crore 68 lakhs 75,000. 17,500 square into 0.50. 15 crore 31 lakhs 25,000. So the total of all of them is 38 crore 12 lakhs 50,000. This is the way we are required to make the computation of the variance, and then we can compute the standard deviation. So answer of the first and the second part of the question has already been done, wherein the expected cash flow and the variance. C part of the question, calculate standard deviation for each project. So write an answer. C part of the question, calculation of standard deviation. Let us see that, say, how to calculate the same. Standard deviation can be calculated as under root of the variance for m and n. As far as the variance is concerned, it is 10 crore 78 lakh 12,500. 10 crore 78 lakhs 12,500. Its root will be calculated. It is 10,383.28. And for project N, it is 38 crore 12 lakh 50,000. It's under root. It is 19,525.62. That's it. This is the way we are required to make the computation of the standard deviation. Now the question says that, you're required to compute the CV. Calculation of the CV is very simple. As far as the CV is concerned, it is indicating risk taken per unit of return. That is what we understand is a CV. CV can be calculated as standard deviation upon X bar. This is the way we can make the calculation. It is in respect of the project M and it is in respect of the project N. Standard deviation is 10,383.28. So risk upon return, as far as the return is concerned, return is X bar, that is 76250. In case of project N, it is 19,525.62 divided by standard deviation, that is, say the mean value, it is an amount of 1,30,000. So 10383.28 upon 76250. So it is 0.1362. This is the risk taken per unit of return. 19525.62 divided by 1,30,000. So it is 0.1502. This is the way risk can be calculated per unit of return, that is CV. Second part of the question, identify which project would you recommend and give a reason. Dear students, over here the answer of the question is very simple. The CV is indicating the risk taken for every 1 unit of return, and of course as a company I would like to take less risk so far possible for every 1 unit of return. So the company would be advised to accept the project M. So answer for the second part of the question, write down. The company should invest in project M because it has lower CV coefficient of variation. This is the way we are required to draw the conclusion. Let us see the next question, question number 7. It is from the chapter of dividend decisions. Akash Limited has 10 lakh equity shares outstanding. Outstanding means issued at the start of the accounting year 2021. The existing market price per share is 150, that is P0 is given to us as 150. Expected dividend is rupees 8 per share. Rate of the capitalization appropriate to the risk class to which the company belongs to is 10%. So discounting rate or cost of capital is given as 10%. Calculate market price per share when the expected dividends are declared and expected dividends are not declared. So if at all the D1 is rupees 8, you are required to compute P1. D1 is 0, you are required to compute P1 based on Modi-Gilani-Miller approach. So we are required to compute the P1 say for different D1. So let us write down answer for the seventh question. Calculation of P1. Dear students, for the purpose of calculation of P1, we will apply the simple formula as P0 is equal to D1 plus P1 divided by 1 plus K. Means end of year 1 dividend income and end of year 1 market price of the equity share will be discounted in present value term, and with that so the P0 is calculated. So P0 into 1 plus K is equal to D1 plus P1. As far as P1 is concerned, it is P0 into 1 plus K minus D1. That is the way the P1 is calculated. So what is market price of equity share? 150. What is cost of equity? Cost of equity is 10% minus D1. So 165 minus D1. We have been provided with the 2 dividend per share, 8 rupees and 0 rupees. So D1 is rupees 8 and D1 is 0. And for both of them we are required to make the calculation of P1. So what will happen? It is 165 minus 8. 165 minus 0. So this will be 165 itself, and over here 165 minus 8, that comes to 157. That is the way we are required to make the calculation of the price of equity share at the end of the first year. Okay. Now second part of the question says that calculate number of equity shares to be issued by the company at the end of the accounting year. That is what technically we understand as the delta N. We are required to find delta N. On the assumption that the net income for the year is rupees 3 crore and investment budgeted is 6 crore. Again, in both the situations, when dividends are declared and dividends are not declared. So when dividend is declared, then of course the amount of the dividend will be rupees 8. So that is taking into account, so the D1 value as 8 and D1 value as 0, we are required to find delta N. So answer of the third question, calculation of delta N if D1 is 0, comma D1 is rupees 8. That is the way, so we are required to make the computation of delta N in both the situations. So D1 is 0 and D1 is 8. In both the cases, we are required to make the computation of delta N. So we start with the profit. Profit of the company is given 3 crore. ND1 is the dividend paid to the existing shareholders at the end of the year. 10 lakh is the number of shares and no dividend is paid in the first case. Retained earning, that is plowback of the income, is an amount of 3 crore once again. Amount of investment is going to be an amount of 6 crore. We have return earning of 3 and the investment, that is expansion of 6. So there is going to be new issue of again 3 crore. That is 6 crore minus 3 crore. P1, price of equity share at the end of first year is 165 if at all the dividend is not paid. So delta N, that is change in the number of shares. It is 3 crore divided by 165. That comes to 1,81,818. Fraction we are ignoring. 1,81,818. That is 3 crore divided by 165. Okay. If at all the D1 is 8, then in that case what will happen? Again the profit of the company is rupees 3 crore. 8 rupees is the dividend per share. 10 lakh is the number of shares. So the amount of the dividend is 80 lakhs. So retained earning is going to be 220 lakhs or 2.2 crore. That is 300 lakhs minus 80 lakhs. Investment is 600 lakhs. So 600 minus 220, new issue is going to be 380 lakhs. 600 lakhs minus 220 lakhs. If at all the dividend is paid of rupees 8, then market price per share will be 157. So it is 380 lakhs divided by 157. So in that case it is 2,42,038. This is the way the number of shares to be issued will be calculated. Third question is proof that the market value of the shares at the end of the accounting year will remain unchanged irrespective whether dividends are declared or dividends are not declared. Dear students, in the third part of the question, we are required to compute the overall market capitalization in both the situations, whether dividends are declared, dividends are not declared. So third part of the question, in that we have to work out the answer in this way. Calculation of market capitalization at the end of year, comma, if dividend is declared, comma, not declared. So let us see that's how to make the calculation of answer. It's very simple. N plus delta N, that is change in the number of shares, into P1. That is the way we are required to find the answer. Dear students, we already have calculated the required details, say in the first and the second part of the question. There are two things. So the D1 is 0 and D1 is rupees 8. As far as existing number of shares are concerned, it is 10 lakhs. Plus, now you can see that, say, if at all the dividend is not declared, then in that case the additional shares that will be issued is 1,81,818. Into market price of the share, it is 165. 10 lakhs plus 181818, that is 11,81,818 into 165. So just I round it off and that comes to 1950 lakhs. This is the way we are required to make the computation of the value of the firm in the first situation. In the second case, what will happen, dear students? Again, the existing number of shares will remain same, 10 lakhs. New issue will be 2,42,038. So plus 2,42,038 multiplying with the P1, price of equity share at the end of the year, and that amounts to 157. So 10 lakhs plus 242038, that is 12,42,038 into 157. That comes to again an amount of rupees 1950 lakhs. This is the way value of the firm can be calculated in both the cases. And as we know that the proposition is that whether you pay dividend or you don't pay dividend, overall valuation of the firm is going to remain same, and that is what we can see over here. Question number 8. Management of the receivable chapter, that is the debtors management. The Alliance Limited, a petrochemical sector company, had just invested huge amount in its new expansion project. Due to huge capital investment, the company is in need of additional 1,50,000 in working capital immediately. So the amount of the funds required is 1,50,000. The finance manager has determined the following three feasible sources of the working capital funds: bank loan, trade credit, and factoring. We have been provided with the information about all of them on the basis of, this is the important word, annual percentage cost. Advise which alternative should the company select, assuming that there are 360 days in a year. So we are required to make the computation of the annual percentage cost for 1, 2 and 3 for all of them, and we are required to choose and option which is having the lowest cost. So friends, we are required to compute the cost for the individual method of financing, and the option which is having the least cost will be selected. So over here the information is given to us that the first alternative that we have is that we can take the bank loan. The amount is 2 lakhs at 15%. It means that we have the funds availability of 2 lakhs. We may not use it entirely. The rate of interest is 15%, and that is a new point that we have is a 10% compensating balance will be required. Otherwise, it would not be maintained by the company. What does it mean? It means something like this. Let me give explanation to you first of all. It says something like this. If at all you are taking a loan of, for example, an amount of 100 rupees, then at the rate of 15% you have to pay interest. Amount of the interest that you have to pay is 15. That is 100 into 15%. Okay. Then you have to keep the compensating balance of rupees 10. What does it mean? It means that you have to keep a balance of rupees 10 over there for every 100 rupees that you borrow. And of course, for this amount no interest will be given to you. So ultimately what happens that you are able to use an amount of rupees 90 in your business, and for using this 90 rupees you have to incur the cost of 15. So the amount of the financial charges that you have to bear is 15, and the amount that you use in your business is 90. So effectively your cost is 16.67. This is the way we are required to compute the cost of the bank loan. That is the first alternative. Second, in that we have been provided with some information. So before we proceed for the second one, let us complete the answer for the first question. Now friends, let us make the calculation of the cost for individual source of finance. The first option that we have is the bank loan. So I request you to write answer along with me. Calculation of cost of bank loan. In that amount and cost. Let us assume that we borrow an amount of just 100 rupees. Then what is the interest cost? We understand it is 100 into 10%. Sorry, 100 into 15%, because the rate of interest is 15%. So the cost is 15 rupees. And importantly, you are allowed to use an amount of rupees 90. How 90 is calculated? It is 100 minus 10. So this is the cost for using 90 rupees in the business. So what is the cost for every 100 rupees? That is the way we are required to make the computation of the cost of capital. That is cost of funds. So it is 15 divided by 90 into 100. That comes to 16.67%. That is the cost of the bank loan. This is the answer of our very first question, that is the bank loan. There is an important point over here for you, that is the compensating balance. Next is second option. The second option is the trade credit. Dear students, you just have to understand and we are having the facility that we can borrow an amount of rupees 2 lakhs. Of course, if at all we have the requirement of the funds less, then in that case, accordingly we will borrow. However, the cost of the borrowing will be 16.67%. The second is the trade credit, in a way that whatever the credit that say we avail, that is the cash discount facility that we avail from our suppliers, we stop availing the same. The company has been offered the credit terms from its major supplier 3 by 30 net 90 for purchasing of the raw material worth 1 lakh rupee per month. So basically whatever this kind of, so the cash discount facility which we are availing, that we will stop availing, and because of that, so we will be able to get the funds, and that amount of the funds can be used for working capital. So trade credit, in that, so the terms have been provided as 3 by 30 net 90. So we understand that say the overall credit period is 90 days. However, if at all we make payment within 30 days, we get cash discount at the rate of 3%. Now we stop availing that, so the discount facility. So what will happen? So we will be able to, so get the funds for the purpose of working capital. But of course, whatever the cash discount forgone is our cost. And for that, so we will apply the simple formula, that is I is equal to PRN upon 100. That is a simple formula that can be applied for calculation of answer. Dear students, over here, either you can take the value of 1 lakh rupee which is given to us in the question, or otherwise taking simple 100 rupees value, you can make the calculation of answer. Yes, in both the cases, in the percentage term, you will get the same answer. And even otherwise, instead of 1 lakh, you take any other amount, in that case also you will be able to get the same answer. What is 3% of 1 lakh? It is an amount of rupees 3,000. The principal amount will be 1 lakh minus 3,000. R is required to be found as balancing figure, and the time period is 90 divided by 30. So 90 minus 30 divided by 360 days. Because the question is specifically providing that you are required to take 360 days in a year. So now R will be found as balancing figure. It is 3,000 upon 97,000 into 360 upon 60 into 100 for getting answer in percentage term. That is the way R will be found. So here it is 3,000 upon 97,000 into 360 upon 60 into 100. It comes to 18.56%. So instead of taking this 1 lakh rupee value, suppose you take the lower amount, 100 rupees, even in that case you will get the same answer. So if at all I would have assumed that the invoice is 100 rupees, then in that case amount of the interest will be taken as 3. Principal will be 100 minus 3. R is required to be found as balancing figure. And the time period will be taken again 90 minus 30 divided by 360. So now R will be found as balancing figure once again, 3 upon 97 into 360 upon 60 multiplying with 100 to get answer in percentage term. So 3 into 360 into 100 upon 97 upon 60. That comes to, of course, once again same 18.56%. These two are again like good questions. In a way, that's the good options. The third is that say we may go for the factoring services. It has been provided to us like this. A factoring firm will buy firm's receivable rupees 2 lakh per month, which have a collection period of, friends, over here it is 30 days. The factor will advance up to 75% of the face value of the debtors at 12% on annual basis. The factor will also charge commission at the rate of 2% of all the receivables purchased. It has been estimated that the firm's services will save, factor services will save the company's credit department expenses and bad debts expenses of 1250 and 1750 per month respectively, on the basis of annual percentage cost. Okay. So let us see that, say, if at all we appoint the factor, then what is the cost? So write on heading factoring services. In that, what will happen? Step number 1 will be calculation of debtors after appointment of factor. Dear students, over here the question does not specify anything specifically about the amount of debtors after appointment of the factor, so we assume it to be same. That is an amount of rupees 2 lakhs. That is the amount of the debtors after appointment of factor. Step number 2 is loan amount. Loan amount will be calculated as debtors less reserve. It has been provided to us that the factor will advance 75% of the face value of the debtors. It has a clear indication that 25% is the factor reserve. So 2 lakh rupees minus 2 lakhs into 25%. That comes to 50,000. So 2 lakhs minus 50,000, and it will be an amount of 1,50,000. That is the way the loan amount will be calculated. Then step number 3 is calculation of effective cost of factoring. As far as effective cost of the factoring is concerned, it will be calculated using a kind of incremental approach. Yes. So we will be having the payment of factoring commission. As far as the payment of the factoring commission is concerned, for that, we understand 2 lakh rupees is the credit sales of 1 month into 12. So the yearly credit sales is 24 lakhs into the factoring commission is provided to us as 2%. So into 2%. This is the way the payment of the factoring commission can be found. 2 lakh into 2 into 2%. That comes to 48,000. Next is payment of interest. See, the amount of the loan is 1,50,000 and the rate of interest is provided to us in the example as 12%. So 1,50,000 into 12%. It is an amount of 18,000. These two are the expenses which we are going to incur with the appointment of the factor, less savings of expenses. Dear students, the question is providing the information that we will be able to save a kind of collection cost and bad debts. It is 1250 and 1750. So 1250 plus 1750 into 12. That comes to 36,000. Okay. So there are two expenses and one savings. This is the way we can compute the net cost. So use your calculator. 48,000 plus 18,000 minus 36,000. So your cost is 30,000 rupees. The amount of the loan which the company is able to obtain is 1,50,000, and it is exactly the same amount that we require. So 30,000 upon 1,50,000 into 100. So in that case, the cost of the borrowing will be 20%. It will be 30,000 divided by 1,50,000 into 100. This is the way we can make the computation of the cost of borrowing, which is 20%. So this is the way we have computed the effective cost of the factoring. Now we are required to make a comparison. The first option has a cost of 16.67. Second is 18.56. And the third is like very high, it is 20%. So we understand like this: bank loan. The next is the forgo cash discount. And the third is factoring. As far as the effective cost is concerned, it is 16.67, then it is 18.56, and then it is 20%. Like that, so you're required to make a comparison, and you're required to make a selection of an option which is having the least cost, that is the bank loan. Dear students, before I proceed further, just I would like to give you some additional explanation considering the kind of questions to which I come across number of times. In case of the foregoing of the cash discount, the question is basically over. So I'm just writing one line answer. The company is advised to take bank loan. Okay. Yeah, before I proceed further, just would like to give you further explanation like this. Listen me carefully. See what happens at over here. Many a times I come across to a question from students that sir give explanation about the cash discount, like the cost, that how basically it will work. That is what the kind of question to which I come across. See what happens at over here, we have to understand that monthly we are purchasing raw material worth rupees 1 lakh. So let us say that on 1st of January to 31st of January, we understand that say at this point of time you have purchased goods worth rupees 1 lakh. Of course, you have a credit period till 31st of March. However, in order to avail the cash discount advantage, so you are making the payment on 31st of January. Over here, what will happen? Now the company will be advised that say do not take the advantage of the cash discount. So you will be having an amount of rupees 1 lakh over here. On 1st of February, once again, you make a purchase for which you are making the payment on 20th of February. Now again, say instead of making payment over here, say of 1 lakh rupee, we will advise the company that say you make the payment in the month of April. So what will happen? You will be able to get the funds of an amount of rupees 2 lakhs. Your requirement is only 1,50,000. So this is the way you will be able to make the arrangement of the funds. Of course, if at all you forgot to receive, that is, say you forgot to claim the cash discount, then in that case, that is going to increase your cost, and that is nothing else but it is a kind of financial cost, and accordingly we take the decision. One more explanation. Many a times the students are having a question to ask me that, sir, over here when you compute the loan amount, at that point of time we take into account the time period of only 1 month, and when we are doing step number 3 we make the calculation of the per annum. Why there is a difference like this? Dear students, understand that whenever say you appoint the factor, then the factor is giving you advance, say for the credit period for which say you are going to say get the funds in advance. So what will happen after 1 month? Listen me carefully. See, on 1st of January, that is the date on which you appoint the factor. 1,50,000 is received by you. On 31st of January, what will happen? Understand carefully. The factor is basically say going to receive an amount of rupees 2 lakhs on your behalf. Minus what the factor will do? Factor will deduct this 1,50,000 which has already been provided to you. Minus the factor will deduct the commission. This 2 lakhs into the rate of the commission is 2%. That comes to an amount of 4,000. And the factor will deduct the interest. It is 1,50,000 into the rate of interest is 12%. Divided by 12. So in that case, say amount of interest that will be deducted will be 1,500. And say this is the amount that the factor will give to you. So 2 lakhs minus 150 minus 4,000 minus 1,500. So you will be able to receive basically 44,500 over here. Now whatever the collection that say you were supposed to have say during this month, and based on that say you were supposed to receive say an amount of rupees 2 lakh minus all the charges. So on 31st of January, instead of that, so that amount is paid to you at the beginning of the month. Same will be the case say for February, same will be the case for March, and so on. Now understand carefully. Say this amount of the commission of rupees 4,000 is collected for 12 times in a year. So 4,000 into 12, that comes to an amount of the commission that is say 48,000. And importantly, this interest of rupees 1,500 is also collected every month. So 1,500 into 12, what is the yearly expense? Yearly expense is 18,000. Accordingly, we are required to make the calculation and we are required to make the selection of the proposal. A very good question in my opinion from examination point of view. Next question. It is a question from the chapter of the management of the working capital. The management of Trucks Company Limited is planning to expand its business and consults you to prepare an estimate of the working capital statement. The records of the company reveals the following annual information. Domestic sales, it is 18 lakhs with 1 month credit. Export sales 8,10,000 at 3 months credit, and sales price is 10% below the domestic price. Material consumption 6,75,000 and average payment period is 2 months. Leg, that is the time lag difference in the payment of the wages half month. Leg in the payment of manufacturing expenses is 1 month. Administration expenses, again credit period is 1 month, 1,80,000. Selling expenses payable quarterly in advance. One quarter is consisting of 3 months. So 3 months selling expenses will be paid in advance. Income tax payable in 4 installments, of which one falls in the next financial year. Gross profit is 20%. Ignore WIP and depreciation. Means we are required to compute the working capital on cash cost basis. The company keeps 1 month stock of the raw material and finished goods. It believes in keeping 2,50,000 available to it, including overdraft limit of 75,000. This is important, not yet utilized by the company. Management is also of the opinion that to make 10% of the contingencies on computed figure, we are required to prepare estimate of the working capital for the next year. That is a question. Dear students, over here the question is providing information about an existing company, and my general suggestion to students to do answer for this kind of question in 2 steps. In step number 1, calculation of the cash cost of the sales, and in second step, calculation of the working capital. So let us start doing the answer. So heading right down, working capital requirement. In that right down, in order to compute working capital for an existing company, comma, usually we have to adopt following steps. Step number 1 is calculation of cash cost of sales, and second is working capital requirement. Like that, so these are the 2 steps in which you have to do answer. So write down answer. Step number 1, calculation of cash cost of sales. Particulars amount. In that, so we'll start with the direct material consumption. It is provided to us as 6,75,000. Next is direct wages, an amount of rupees 5,40,000. Next is manufacturing expenses. It is an amount of 7,65,000. Next is the administration expenses. Now, dear students, over here, basically, with respect to the calculation of the finished goods valuation is concerned, for that, the institute is not having such a consistency in providing the suggested answer. Number of times the administration expenses are excluded, and number of times it is included for calculation of answer. In this example, as it has been added in the suggested answer, so even I added for the purpose of doing finished goods valuation. So you can put your note accordingly, and accordingly you can have the valuation of the finished goods. So the administration expenses are 1,80,000. So we will be having, so the cost of goods produced as 6,75,000 plus 540 plus 765 plus 1,80,000. That is 21,60,000. So this is cost of goods produced. Now the opening finished goods is added and closing finished goods is deducted. However, for an ongoing concern, we have an assumption that opening and closing are same. So whatever is the cost of goods produced itself is cost of goods sold. Cost of goods sold. Again, it is an amount of that is 21,60,000. Now we will have, so the adding of selling expenses. The selling expenses are provided as 1,12,500. With that, so we'll get the cash cost of sales. It is 21,60,000 plus 1,12,500. So 22,72,500. This is the way cash cost of the sales is calculated. After making calculation of cash cost of the sales, we'll compute the working capital. So let on new heading, calculation of working capital. So let us see that's how to make the calculation of answer. Again, column number 1 is particulars and column number 2 is answer. In that, so we'll start with the first raw material stock. Stock of raw material will be calculated as raw material consumption divided by 12 months into raw material holding period. This is the way the stock will be calculated. So the consumption of the raw material is provided to us as an amount of 6,75,000 and the raw material holding period is given as 1 month. So over here it is 6,75,000 divided by 12 into raw material holding period is 1 month. So stock of the raw material is 56,250. Next is WIP. However, the question says that ignore WIP. So WIP is 0. Next is finished goods. As far as the finished goods stock is concerned, it can be calculated like this. Cost of goods sold divided by 12 months into finished goods holding period. That is the way it is calculated. COGS is 21,60,000 divided by 12 months into finished goods holding period is once again 1 month. So the finished goods is 1,80,000. Next is the debtors. Dear students, for calculation of the debtors, we have to prepare a separate working note. The reason behind that is that say we are having say not only the domestic sales but also the export sales. So I keep this pending. Cash and bank. We have been provided with the information that say we want to keep the cash balance of 2,50,000. However, 75,000 rupees is the OD limit which has not been utilized by the company. So the amount of the cash balance that say we need to maintain is 2,50,000 minus so the amount of the bank overdraft which has not been utilized by us, because that amount is available to us at any point of time. So 2,50,000 minus 75,000, so it comes to 1,75,000. Next is like advance tax. It has been provided that the 3/4 will be paid in advance. We can see that the income tax provision is provided to us as 1,68,000. So of that, the one installment is due in the next year, and the remaining 3/4 must have been paid during this year. So 1,68,000 divided by 4 into 3. So 168 into 3 divided by 4, 1,26,000. So almost all the current assets are covered except the debtors. Now we can start with the liabilities, in which creditors for raw material. It will be calculated by taking into account the annual credit purchase and average payment period. So we'll work out the answer in this way. It is annual credit purchase divided by 12 months into average payment period. This is the way we are required to compute the answer. As far as the purchase calculation is concerned, friends, it can be calculated like this. It is closing plus consumption minus opening. That is the way the purchase can be calculated. It is closing stock plus consumption minus opening, whole divided by 12 months into average payment period. Dear students, for an existing concern, we'll make an assumption that the closing stock and opening stock would be same. That is over here 56250. So in that case, what will happen? The purchase will be equal to the consumption. Why? Because the opening and closing is same. That is an amount of 6,75,000. We do not have to put any note for the same. It is implied like that only. Average payment period is provided to us in the table. It is say the 2 months. That is the way the creditors can be calculated for raw material. It is 1,12,500. Okay. Afterwards, we have been provided with the information about the leg in the wages is half month, leg in the payment of the manufacturing expenses is 1 month, administration expenses is 1 month, and there is prepaid sales promotion expenses. Okay. So prepaid sales promotion expenses, that is the part of the current assets. It is annual selling expenses divided by 12 months into time period. Annual expenses are 1,20,000. Sorry, 1,12,500. So it is 1,12,500 divided by 12 into 3. 28,125. Then outstanding wages. As far as outstanding wages is concerned, it will be calculated as annual wages divided by 12 into average payment period. Annual wages divided by 12 months into average payment period. Annual wages is provided to us in the example as 5,40,000 divided by 12 months into 0.5 month. That is the way we can compute the annual wages, the outstanding wages. 5,40,000 divided by 12 months into 0.5 month. Outstanding wages can be found. So 540 divided by 12, that is 45,000 into 0.5, 22,500. Then for manufacturing expenses and administration expenses, we can prepare the combined working because both of them are having, that is outstanding for the same time period. So outstanding manufacturing and administration expenses. Annual expenses 765 and 180. $765 plus 180 divided by 12 months into 1 month. This is the way we can compute answer. 765 plus 180 divided by 12, 78750. Next is the income tax provision. It is an amount of 1,68,000. Dear students, you can very well understand that over here, since I have mentioned the advance tax of 1,26,000, so I'm writing the entire provision over here on a liability side. That is as current liability. Otherwise, what you can do, 168 divided by 4, you can only mention income tax provision, net of the advance tax, 42,000. I have mentioned the cash balance over here, 175. Instead of 175, you may mention the cash balance of 2,50,000 and bank overdraft of 75,000. That is also a valid presentation from examination point of view. This is the way we are required to make the calculation of answer. And now we are going to understand how to make the calculation of debtors. Let us see that say how to make the calculation of the debtors. We'll keep some line over here blank. Write on heading debtors. As far as the debtors are concerned, it can be calculated by one of the two methods. Method number 1. Now method number 1 works out in this way. We understand that the sales, domestic and export amount. We can see that say, as far as the amount of the sales is concerned, domestic sales is 18 lakhs. As far as the export sales is concerned, it is 8,10,000 divided by 0.9. Because language of the question speaks that as far as our export selling price is concerned, it is 10% below the domestic price. So we can gross up to compute that say what is the equivalent sales value. That is an amount of 9 lakhs. So the total comes to 27 lakhs. Proportion 18 upon 27, that comes to 2 by 3. 9 upon 27, that comes to 1 by 2. Cost. We already have calculated the cash cost of the sales. It is an amount of 22,72,500. So this cost will be divided into this ratio, 22,72,500. That comes to 757,500. 7,57,500. And the domestic sales cost is 15,15,000. Now based on this, we can compute the debtors value. We have been provided that say to our domestic customers, we offer a credit period of 1 month. So what will happen, dear students? It is 15,15,000 divided by 12 months into average collection period is 1 month, and 7,57,500 divided by 12 months once again into average collection period is 3 months. That is the way the cost can be calculated, because you can see that the credit period is given to us. Export at 3 months credit and the domestic is at only 1 month credit. So use your calculator along with me. 15,15,000 into 1 divided by 12. That comes to 126,250. And 7,57,500 into 3 divided by 12. That comes to 1,89,375. And accordingly, we will compute the overall debt, that is the debtors value. It is 3,15,625. This is the amount of the debtors, so that is what we can compute. Now, after making calculation of the debtors, let us see that how we can make the computation of the debtors in an alternative manner. The method number 2 is like this. In that, you can compute the weighted average collection period. So, working note number 1, calculation of weighted average collection period. Let us see that how we can compute the answer. Again, there are two types of sales. One is the domestic and another is export. First of all, we are required to make this proportion to be calculated. Okay, that is 2/3 and 1/3. So proportion is 2/3 and 1/3. Credit period. For the domestic customers, the credit period is like only 1 month, and for export it is 3 months. So it is proportion into credit period. 2/3 into 1, that is 2/3, and 1/3 into 3 is 1. So the total would be 1 2/3. This is the way the weighted average collection period can be calculated. After making calculation of the weighted average collection period, you can compute the data. That's very simple. It is cash cost of credit sales divided by 12 months into average collection period. It is 22,72,500 divided by 12 months into average collection period. That is 1 2/3 month. So 22,72,500 divided by 12 into 1 2/3 month, and the answer comes to 3,15,624.99. So of course it is 625. This is also the way we can compute the answer. After making the calculation of the debtors, we are required to complete the remaining working. So amount of the debtors in that, so the refer working note. It is 315,625. Now finally the working capital calculation. Dear students, 56250 plus 1,80,000 plus 315,625 plus 1,75,000 plus 1,26,000 plus minus 1,12,500 plus 28,125 minus 22,500 minus 78750 minus 1,68,000. Okay, so it is 499,250. That is the working capital requirement before margin for contingencies. that is an amount of 4,99,250. Then we have been provided with the margin for contingencies to be kept as 10%. So add margin for contingency. It is at the rate of 10%. So 4,99,250 into 10%. So it is 49,925. So the amount of the working capital would be 4,99,250 plus 4,99,250. That comes to 5,49,175. This is the total working capital requirement. This is what we understand. Let us have a small summary of the entire answer. Dear students, in this question, in my opinion, the important point of the working is the data's calculation. Except that everything is like very simple for a student to understand. First of all, the information is given for an existing concern. So there are two steps in which I suggest students to do answer. Step number one is calculation of the cash cost of the sales, and the second step is the calculation of the working capital. For an existing concern, we will make an assumption that the opening stock and the closing stock would be same. So whatever is the raw material consumption itself is the raw material purchase. Whatever is the cost of goods produced itself is the cost of goods sold. That is the reason we understand that say we have to calculate directly the cash cost of the sales. Material, labor, manufacturing expenses, and importantly they have provided the suggested answer in which the administration overhead is considered to be part of the finished goods valuation. Many a times it is ignored, so you just have to write an assumption, you just have to write a note that say what kind of treatment that say you follow for administration expenses. So cost of goods produced and sold is same 21,60,000. Adding selling expenses will give the cash cost of sales. Next is the statement of the working capital. In that say the stock of raw material, that is consumption divided by 12 into raw material holding period. Next is the WIP finished goods, debtors, and say for debtors we have to prepare important clear working note. For cash and bank, a small information is provided to us that we require the total cash and bank of 2,50,000. However, for 75,000 rupees, we already have the bank overdraft limit which we have not used. So basically, we have to arrange the cash only for 1,75,000 rupees. If at all you mention the cash and bank balance 2,50,000, then in that case, the bank overdraft will be mentioned 75,000. Advance taxes say like out of 4, 3 installments have been paid. So the total amount divided by 4 into 3, that is what say you have paid at the end of the year. And we will mention the income tax provision say as the like liability. Otherwise, we can show 1/4 as outstanding. That is also the way you can present your answer. Creditors for raw material will be based on the purchase only, and this time the purchase and the consumption would be same. Next is the prepaid selling expenses, outstanding wages, manufacturing and administration expenses, tax provision, and then margin for contingencies. This is the important working note that we have. Importantly, the question is providing the information that we sell goods at 10% lower than the domestic price. So what happens that say in equivalent term, say it is 18 lakhs and 9 lakhs. Why do we make this calculation? So basically we understand that say whatever the units that say we produce, Of that, two-third number of units have been exported, and one-third number of two-third number of units have been sold in the domestic market, and one-third number of units say have been exported. That is the way we do bifurcation, because whatever the product that say we like sale, it will have the same cost of the manufacturing whether it is exported or say it is sold in the domestic market. So this bifurcation is necessary. And further, of course, both of them are having such a separate credit period, so we do such bifurcation. So the total cost of 22,72,500, out of that, say a certain portion of the cost is incurred for domestic and certain portion of the cost is incurred, say for that is the export. And then we make the computation of the debtors, say based on that working. Method number 2 is we compute the weighted average collection period. The proportion is 2/3 and 1/3 once again. Credit period is say 1 month and 3 months. That is the alternative method by which you can do it. So you can compute the weighted average or overall collection period. It is 1.666666. That is the way. So we have the collection period. And based on that, say finally, say we make the computation of the debtors. And lastly, like the working capital margin and so on. Next question, question number 10. Discuss the points that demonstrate the importance of good financial management. That is a question. Dear students, answer of the question is like this. Points that demonstrate the importance of good financial management. First is taking care not to over invest in fixed asset. Dear students, investing more in fixed asset is indicating that say you are having say the more amount of the fixed cost in the business, that will increase your degree of operating leverage, and with that say the risk will increase. Balancing cash outflow with the cash inflow, we have to make sure that say whatever the profitability that say we have, that should be reflected in the positive cash flow also. It should not happen that say we are selling goods on credit, and because of that say the profit is there, however we are having say the poor cash position. We are purchasing the raw material or the goods like in quantity so as to avail the discount. However, say in that case, say we will be having say the poor cash position maybe. So we just have to make sure that say we have the balancing inflow and outflow, ensuring that say there is sufficient level of the short-term working capital so as to reduce say the chances of any technical insolvency, bankruptcy. Setting sales revenue target that will deliver the growth. We should be able to get the increase in the sales. Increasing gross profit by setting the correct pricing for the products or services. So we are required to say increase the gross profit by say keeping the correct pricing of the product and services. We have to make sure that say we keep the price which is reasonable so that the customers can afford. At the same time, say we are keeping the price that's because of which we are also able to get the margin. Controlling the level of the general and the administration expenses by finding more cost efficient ways of running the day-to-day business operations. That is what say the general point. Tax planning that will minimize the tax a business has to pay. There may be say certain say the like the investment that say you are going to make, or there will be say certain like the purchasing of the fixed assets at the end of the year, so that say you can claim the depreciation allowance, or otherwise say you locate your like the entire project in say certain areas because of which you get the subsidy, you get SEZ, that is you get say certain like the incentives in terms of the waiver of the tax, something like that. This is the way so you can have the tax planning. So these are the what we understand is like importance of the financial management. Explain some common methods of venture capital financing. Dear students, we understand that the term venture stands for something that say you are going to do, say very risk is there. So if at all, let us say that say start a new business, say with certain innovative idea. If at all that idea is successful, then in that case I will be able to do wonders. However, there are fair chances that say I will not be successful. In that case, whatever the investment that I made, say I may not be able to recover it. This is what say we understand is a venture, and somebody who will finance say this kind of venture is called venture capital financer. The question says over here that say what are the ways by which a venture capital financer will give the venture capital financing. Logically speaking, we understand that say as an entrepreneur, when I'm going to say do any startup, at that time the risk is more. I want somebody who will share the risk with me. So venture capital financer would generally make the investment in such a way so that say he will be sharing the risk, and of course with that so the return also. If at all the business is not doing well, then in that case of course the financer will lose. But if at all the business is making a gain, then in that case the venture capital financer would be able to get a good return. So keeping something like this in mind, we are required to understand that say what are the methods by which so you can have the financing. Uh, they have provided something like called equity financing, then conditional loan, income note, and participating debenture. So these are the certain methods of financing that say they have. I just read that once again. It is equity financing. The second is the conditional loan. Next is the income note, and the last is the participant debenture. So it is something like SEBI, or you may remember it as SEBI, that word that you come across number of times. With SEBI, you may remember this, say, like the heading. So first of all, it is equity financing. Logically, we understand that so the equity financiers are such financiers who are going to bear the risk of not like the business or venture is going successful, and at the same time say they will share the revenue if at all the business is successful. The second thing is that say the venture capital financer is basically a financer only, and he is not say the like the key person who is doing business. That is the reason say the equity stake will not be kept in such a way so that say he will be having controlling interest, and he will be purchasing the equity shares maybe maximum up to 49%. So let us read this. The venture capital undertakings generally require the funds for longer period, but may not be able to provide the returns to the investor during the initial stage. Therefore, the venture capital finance is generally provided by way of equity share capital. Equity contribution of the venture capital firm does not exceed 49% of the total equity capital of the venture capital undertaking, so that the effective control and the ownership remains with the entrepreneur. Second is the conditional loan. A conditional loan is repayable in form of royalty. So basically the royalty is required to be paid only if you have the successful business, that is the sales. After the venture is able to generate the sales, no interest is paid on such loan. In India, venture capital financiers charge royalty ranging from 2% to even 15%. Actual rate depends on other factors of the venture, such as gestation period, that is the time period in which the business is likely to generate the profit, cash flow pattern, risk, and other factors of the enterprise. Some venture capital financiers give a choice to the enterprise of paying high rate of interest, which could be well above 20%, instead of royalty on the sales once it becomes commercially sound. So this is what we have say in case of say the conditional loan. So you are required to mention Say the point of the royalty, say in this question, that is in this point, that is ranging from 2% to 15 percentage, and the other is that say it may be the interest wherein it can be very high rate of interest, even that goes up to 20 percentage. The third is income note. It is a hybrid. Hybrid means combination. Security which combines the features of both conventional, that is the older one, and conditional, that is the slow. The entrepreneur has to pay both interest and the royalty on sales, but at a substantially low rate. IDBI's venture capital financer provides funding equal to 80% to 87.5% of the project cost for the commercial application of indigenous technology. Participating debenture, that is one more way of the raising finance. Such security carries a charge in three phases. In the startup phase, no interest is charged. In the next stage, low rate of interest is charged. Up to a certain, that is a particular level of operation. After that, say the high rate of interest is charged. That is the way, say the interest will be charged progressively. Dear students, I always suggest that say make sure that say you prepare theory well from examination point of view. Second thing, that say you don't have to write only the head points properly. Along with the writing head points properly, so you are required to make sure that say inside that also you are writing which is say relevant. That is over here 49 percentage, over here royalty 2% to 15 percentage, interest up to 20 percentage, IDBI 80 to 87.5 percentage. It is a hybrid, that is a combined security. Participating in that, so there will be stage-wide interest that will be charged. And you can remember, like by any other method, SEBI is what one of the method that I suggest. So let us see the question number 1, which they have provided over here, is of the ratio analysis. In my opinion, that's it is comparatively a simple question. Similar to this, they have provided number of times questions in examination. The second question is again like simple, weighted average cost of capital to be calculated. Not something which is great or like very difficult to do. So the second question is cost of capital. Again, it is a simple question. Next, the capital structure. In that, again a simple question. Fourth question, leverage. Again over here we are required to make the computation of earning per share and different kind of leverages. The question says that so you're required to measure the risk, so you're required to find leverage. Next question, that is of the capital budgeting, investment decision, and this is what I found it very good question. This is like an important question that so you need to revise say before examination. Recently in July 2021, there was a question asked in examination wherein again the concept of the block of asset was tested by institute. So a good question once again. Risk analysis in capital budgeting. Not a difficult question. Risk analysis in capital budgeting. Simple question, not something great. Question number 7 is the dividend decision, wherein we are required to make the computation of the value of the firm using approach, and of course the value is going to remain same. Question number 7 is a chapter, that is a question from the chapter of dividend policy. Approach, and again it is a very simple question. Similar to this, number of questions have been provided by the institute in module. So nothing is great as such. This is a good question. Yes. This is really a good question. The reason behind that is the compensating balance is a good point that we have. Foregoing of the cash discount facility which you are availing right now, and calculation of the cost of the factoring with the given information is a good point. So I suggest all of you strongly that say you must revise this question before examination. So the receivable management, in that it is a very, very good question. Question number 9, management of the working capital. That is a simple question. Nothing is great about it except the calculation of the debtors. So it is like a simple question that we have. So these are like the good questions that we have, say, from examination point of view. Question number 5 and question number 8. These are the good questions. And the 10th is a theory question. In the theory question, both the questions that say they have provided are very, the second question is almost provided for number of times. It is there in the module also. This 10A is comparatively a good question. So wish you all the best for examination, all of you, and do prepare well and have the writing practice, say, before your examination for the subject.